Good evening, everyone. Welcome to our UCI alum homebuyer masterclass. We're going to teach you all kind of the key elements to home ownership tonight in just 1 hour. This is a very interactive class that we provide to our alumni communities all across the country. So we're excited you can get a chance to join us tonight. This is a very interactive session. So as I go through tonight's content, we'd love to get your questions. You can use obviously in Zoom the Q&A feature or chat. I'll be checking those out, and then we'll be able to answer your questions on air. But we just want to provide you just some value tonight, so you can really learn a little bit more about what homeownership can mean for you. And as you're setting financial goals for the balance of 2026 or into next year, at least if homeownership is part of those goals, you're going to learn some different resources that are available to you and really how the buying process works. Well, I'll be your presenter tonight. Again, my name is Jason Mehta, and I work for an organization called APM, or American Pacific Mortgage. We're a nationwide lender. We're the 9th largest lender in the country, and our team in particular focuses on first-time buyer education. So we partner with alumni communities like UCI to just bring education to those communities all across the country to help them in the community understand more about home ownership. Because let's face it, this is the biggest financial decision that you're going to probably make. And so having a class like this, we hope this will give you enough kind of insight as to home ownership and potentially be the launch pad into your consideration of home ownership. In tonight's class, we'll talk through a couple things, which will include the housing market, what's happening with interest rates. We'll also do a rent versus buying scenario where we'll compare someone that's currently renting today versus what it looks like if they decide to become homeowners. Talk more about credit, how we can build credit, but tips on credit and how you can improve your score. We'll outline some different loan programs, as well as talk about savings for home ownership and the expected down payment requirements to buy a house. And then we'll learn about first-time buyer programs. I think most of us attending tonight's class are probably somewhere in the California markets. So we'll spend some time looking at the California Housing Finance Agency programs. And then one of our kind of talking points later on in our class will be just the buying process. What does it look like to go from like tonight's class into like the workflow of buying a house and connecting with me for your free consultation? So we spend a lot of our days, if we're not teaching classes, just to consult with clients on what home ownership could look like for them, building budgets and plans. And so we'll kind of talk to you as we wrap up tonight's class on what that might look like for you as one of your next steps. Well, let's go ahead and dive in, and we want to kind of just start talking about buying. Does it even make sense for us? I just mentioned it's probably the biggest financial decision that you're going to make. And obviously, you probably have some other things you'd rather do on a Thursday evening. So taking some time for the next 60 minutes to learn a little bit more. Obviously, you understand kind of the magnitude of this decision. When you think about home ownership, there's opportunities to create stability in your housing payment. You don't have to worry about maybe your landlord coming to you with a new lease agreement and saying, hey, your rent's $300 more a month. You now have more of a fixed payment in home ownership. Many of our clients that are purchasing in today's market, even though we're still at elevated rate levels, will have an opportunity to refinance their homes at some point in time. And there is the element of an asset that's going to grow for you when you're a homeowner, because as you look at your home's value, as it goes up and as you pay down your mortgage, it creates home equity for ourselves as owners. And for most of us, this is a financial tool that can help really grow over time, whether that's allowing us to do improvements on our house, to pay off debt, or just to have more wealth in general. This really has an opportunity to create transformations in families and home ownership. And there's also tax benefits that we don't always put into the calculations in home ownership, which potential tax deductibility of interest, as well as potential tax benefits that can come along when we have home ownership. So those are really important things to consider. And in our classes, to be able to kind of launch that or to better understand that, I always like to also share back with our audience a financial calculator. It's called our rent versus buying calculator. And I'm going to kind of make a few changes on this tool, but I want to kind of show you this because it'll be one of the many tools that we send back out to you in tomorrow's email. So we're going to send out to you the link to the recorded version of tonight's class. We'll also send our slides as well as some of these links. So I'm going to go ahead and just build out a quick little scenario for you. And this is ultimately going to show you framing up renting for the next several years versus buying for the next several years. So let's say we bought a $600,000 home. And I know for some of us, if we're in Irvine, that's probably not much. Maybe that's a condo or less. But let's say we bought a $600,000 home. We financed 97% of that purchase price, right? We'll have an average interest rate that gets plugged in. So we're going to, interest rates are starting to move a little more positively, but let's say that's at 6.375%. And you decided to purchase your home, in the next couple months. Okay. So we'll have that as, kind of where our calculator starts. Now you're going to learn a little bit about mortgage insurance tonight, which comes into play when I put less than 20% down to purchase my home. So there's some factors that go into that calculation. So that's included here. We have homeowners insurance. We have some taxes, depending on where we buy our house. Those taxes might vary. Maybe we're deciding to buy a condominium or a townhouse. There will be HOA dues as part of our overall expenses. And then we also want to consider, and I mentioned it just a few minutes ago, tax advantages of owning a home. So tax bracket of where we land is really important. And then from an expense perspective, what do I pay in maintenance costs for my home? Am I eventually going to sell my house? What does the cost look like for that? And so those are all taken into consideration in this calculator, as well as what am I paying today from a rent perspective? So let's just say we're spending $3,500 a month in rent, and that's not out of this world, really, for some of our markets that we have in California. We also will have more than likely renter's insurance expense, as well as the expectation that my rent will go up at least 2% per year. So what our calculator comes back to tell us is if we were to look at our investments into homeownership, down payment, closing costs, and all the benefits that come along with home ownership, tax deductibility of interest, equity appreciation, and we compare that side by side to renting, right now at year 3, we're going to have our break-even point. So meaning with all those investments and just mapping that out against renting, I'm going to be breaking even at 3 years. And anything beyond that's obviously on the positive side. And after I kind of span this out, let's say to 10 years, my buy opportunity is over $128,000 as compared to renting. Obviously, these numbers will change for everyone in class's situation. So whether you're renting at a certain level or considering buying at a certain level, the numbers will change. I would encourage you, if you have some time, once you get all of our tools back tomorrow, kind of walk through that calculator. It's also part of our discussion points during a consultation with you. So we'll certainly walk through that as well. But I always find that to be a really useful tool in helping clients better understand the benefits around homeownership. Now, when we decide to get into homeownership and our entry point to the market, it will change based upon what the housing market is doing. This is just a glimpse at kind of the Riverside housing market, just so you can get a kind of a sense of some neighboring counties. The market right now is in the middle of its spring buying season. Spring and summer buying season are generally the busiest times of the year in the marketplace. And our challenge over the last couple of years has always been, is there enough supply to support buyers? And we are starting to see supply shift a little bit. I think sellers are starting to reset expectations, whether that's the price of their home or making concessions to buyers for what we call closing cost credits. So we're starting to see some shift in the market. There are some priced homes that are on the market, overpriced, I should say. And we're seeing those sit a little bit longer. So the average days on market has definitely increased. We're looking at 2026 to be a bit of a reset in the housing market, with home buying being a little bit more affordable than it has, especially over the last couple of years. And so that's encouraging to see. We're not going to see major price growth in most markets across the country. We're also seeing some dips in certain areas. And some markets are going to probably just see some leveling essentially with price. Inventory has always been a challenge, but I think we are starting to see some improvements in some markets in inventory. Things will look a little bit different in Irvine than they do in, let's say, looking up in LA County and getting into some areas of there, or getting into more of kind of the inland counties that, we get into Riverside and San Bernardino County. It's interesting right now, about 40% of all transactions that we're a part of today have some type of seller concession in them, whether that's reduction in price, that includes credits towards closing costs. So I do think there is starting to see a little bit of a shift. I wouldn't call this a buyer's market by any stretch in California, but we are seeing buyers that aren't just have to kind of sit back and just take whatever terms a seller provides to them. There is some negotiating that's still happening. Um, Ultimately, I think for those of us that are kind of really financially ready and feel like this market and where they're at in their kind of their financial situation, there is an opportunity to be able to capitalize into home ownership. And if we look at, our forecast of 2026 year over year, this kind of shows us what we've seen in the last 7 years in the market. And, obviously prices of homes have continually steadily rose. You can see in 2026, we'll still see an increase in the housing market, about a 2% change. Median price going higher in California, 3.6% uptick. Affordability in California going higher just because the price is going higher. Although the 30-year fixed mortgage, in which we're going to talk about in just a few minutes, is ultimately having some challenges because, right now we've had a really volatile financial market. A lot of that being a part of the conflict in the Middle East has really kind of changed the dynamic of the financial landscape. Mortgage rates as of late are starting to react positively. We've seen even today, we saw rates kind of slip down a little bit lower. Average rate interest rate now has decreased to about 6.4%. This slide shows you the interest rate performance over the last 3 years. And so we're not at the lowest levels in 2026, but we've trended in the last week in a much better level. There was a lot of instability in interest rates going back just a week or so. A lot of that, again, going back to the conflict in the Middle East, where we saw oil prices rising over $100 a barrel. I think today we're somewhere around $70, $71 a barrel. And that in the financial markets are kind of, a little bit more recovery mode. But the markets remain very volatile for our clients. As an expert in kind of analyzing the market, one of the things we do as part of your home buying plan is once you're under contract with a seller, we're going to try to strategically watch the markets to try to time interest rates as best as possible. In this type of market, we're going to help educate you on what's happening in the market so you can make a great informed decision. Now, interest rates aren't the same for all clients. There's various characteristics that go into interest rate, like credit score and eligibility, the type of program and how much I finance, how much my down payment is, and am I going to be buying points to bring down my interest rate? Not always something I would recommend in today's market. Buying points equates to at least 1 point I should say 1 point equates to about a 1% of your loan amount, which will generally drive down your mortgage interest rate by about 0.25%. Loan term can also lower my interest rate or have an effect on my interest rate, but think about it. When we take a payment on a 30-year loan and shrink that down to 20 years or 15 years, it's going to elevate the amount of monthly payment. So most first-time buyers are electing a 30-year fixed mortgage product. It's ultimately our job to really kind of help design options for you in home ownership so you can understand all the financial tools that are available to you. But I think it's also important to understand what makes interest rates go, right? There's different elements. It's not a one size fits all with mortgage interest rates. Credit plays a major role in interest rates. And as we consult with you for your home buying plan, we're going to talk through credit, where you stand today, and what really presents itself as areas of opportunity for you to help lift your credit score. The reason why we want to do that is because every loan program has a minimum credit score attached to it. And that credit score plays a role not just in the product selection, but your interest rate, as well as mortgage insurance when you decide to put less than 20% down to purchase your home. Now, as we know, there's 3 different agencies that report credit. There's Equifax, Experian, and there's TransUnion, right? We take the middle credit score of all 3 bureaus that report out. So if your highest score is 760 and your middle score is 740 and maybe your lowest score is 720, we're going to use 740 as that middle score for qualifying purposes. Now, if you're looking to apply with your partner and your partner scores are 720, 710, and 700, well, that middle score is 710. And that's important because we take the lowest middle credit score between both borrowers when qualifying for a mortgage. Now, when you've had past challenges on your credit report, let's say a late payment or you're over limit on a credit card, if that happens in the most recent 12 to 24 months, so when that event happens in the most recent 12 to 24 months, that's going to have an impact to your credit score. The further I get away from that event, the larger improvement I'm going to see on my credit score. Now, when we look at how long some of those negative items will stay with me on my credit report, this is a matrix that can help you better understand that. So if I was late on my, student loan payment back in October of 24, once I hit October of 26, I probably won't have as big of an impact on my score because now we're at that 24-month mark. But that late payment is still going to stay with me on my credit report. So that late payment will be there for 7 years. Other events, bankruptcies, federal debt that's in delinquency, this is how long that'll stay with you on your credit report. Now, there's different models to credit scoring. So we have the 3 different agencies, but we also have different models to credit scoring. That includes a credit card model, which, by the way, shows up in your monitoring services. So if you guys subscribe to Credit Karma or some of the credit agencies' monitoring tools, they generally use a credit card model. There's also auto financing, which is obviously buying a car, and then mortgage for when we look at getting financing for our home purchase. I want to walk you through the FICO score calculation for home mortgage because I think it's, important to understand what elements go into that score. And my hope is that in class, you'll kind of identify some areas of opportunity for you in your own score to see where we can help move the needle in your score. 15% is going to be how long have I had credit. So the more mature my credit file is, the better my credit score is probably going to be. And then 20% is going to be how much new credit am I trying to obtain? Am I opening up a bunch of new accounts? Do I have hard inquiries on my credit report? Those things can negatively impact your score. You really want to avoid hard inquiries, especially in a 6 to 12-month period, because that will hurt the credit score. In our process for financing, we only start with a soft credit check. And the reason why we choose to do that is because many of our clients that I consult with on homeownership aren't going to run out and buy a house this weekend, right? It takes several months, maybe even a couple of years for us to be in position. So we want to provide you some education in homeownership without impacting your score. So we always start with that soft credit check. 30% is going to be how much do I owe in my revolving credit balances. So we're looking at credit limits versus credit balances. The higher my percentage is, the more pullback I'm going to have on my credit score. So if I have $8,000 in credit balances, 10,000 in limits. Right now, I'm at 80% utilization of credit. What we would want to try to do as our game plan is to try to move that below that 50% threshold to lower that utilization. Then I'll probably see some uptick in my credit score, eventually get to 30% utilization. And my end goal is to get below 10% utilization. Now, one of my tips I'd like to give you for class on credit management on cards is to do your best to try to pay off or pay down credit balances before the end of your billing statement date. So what does that mean? Well, if your billing statement date ends on the 20th and your due date for your card is on the 3rd, do your best to try to pay down that balance or pay it off, obviously, before the end of the billing statement date. Because when that date closes out, then the credit card issuer is sending all your account information out to the 3 bureaus. If you can catch that before the cycle date closes, then you improve your credit score because hopefully you've paid down your balance and because now you have lower utilization. The last component to the credit model is going to be what we look at from a payment history perspective. So we're looking at obviously late payments, and those get rated as 30-day lates, 60-day lates, and 90-plus day delinquencies. More severe the late payment is, the bigger impact I'm going to have to my score. Again, going back to that 12 to 24-month rule. Now, one of the accounts that shows up on credit reports is student loans. And some of you in class may have student loans, and that's not out of the ordinary for us to actually have those conversations around student loans, because a lot of our clients that we work with in our alumni communities are working with student loan debt, whether they're in active repayment or they're currently in forbearance or deferment. So I thought I would share back with you how we look at that from the lending perspective. So if you're in active repayment right now, and let's say you have $75,000 worth of student loan debt and you're paying $250 per month, we can use that payment right away. That's totally something we can do in qualifying for your financing. Where I think we have bigger challenges, and that they're not insurmountable, but they're challenges when you're in forbearance or deferment, because now you're not in an active repayment plan. So if I still have that same $75,000 in debt, if I'm trying to qualify for a Fannie Mae conventional loan, then I have to assess 1% of the balance, or $750 per month, as a monthly payment. If I'm doing an FHA loan, it's half of that, $375 per month. And that can really move things when it comes to qualifying. So we want to really talk through that. And ideally, clients that are in income-based active repayment programs are going to have a lower monthly amount that we have to count into the qualifying. Because in financing, we take a look at your total debt on a monthly basis, credit cards, student loans, auto payments, as well as your projected housing payment. It's called debt to income ratio. And we compare that versus your income. And we'll talk more about that tonight, but that's why we have to kind of dig into student loans and understand where they stand. And part of that is because every loan program has set underwriting guidelines that tell us how we need to calculate those student loans. In this product segment that we go through right now, I'm going to take you through some high-level look at some of the products that are available to you as home buyers and first-time buyers for that matter. The first product is a conventional home loan, which is a Fannie Mae Freddie Mac loan, minimum down payment of 3%. A conforming loan limit is set every year, which you can see that number on screen. But for those of us that are in Orange County or LA County, there's what we call high balance, which takes us up to a larger loan amount, over $1.2 million in loan amount. But anytime we go beyond the 832,750 figure, our minimum down payment jumps from 3% to 5%. Okay, so that's a conventional home loan. And then on the FHA side, that is a government insured loan. The down payment is at a 3.5% minimum. And then the maximum loan amount does change by the county that you're going to purchase in with the FHA product. Now, both FHA as well as the product just below it, USDA, are both government insured loans. So they do require you, with some recent changes, in the last 6 to 7 months, it does require you to be a permanent resident to access both products. But the conventional loan, you can be a non-permanent resident and still have access to a Fannie Mae or a Freddie Mac loan. USDA is going to be for a product that clients are going to use if they're buying in more rural areas. They can utilize that product, and it's beneficial to them because it has a no down payment option. But there's qualifiers like location of the home has to meet the USDA location requirements, and there is maximum income by household. And then the jumbo loan will probably not be our first time buyer path, but it does at times. And part of that is just because it's designed for like higher amount financed loans, as well as higher down payments, 10 to 15%, higher credit score requirements. But jumbo is certainly an option for us as first time buyers. We also do have a physician's loan. So if you're in residency or in a new practice and you're looking to have some relief on some of the student loan calculations that we talked about in your financing scenario, a physician's loan can help those that qualify to get a little bit more kind of flexibility in eligibility when it comes to like educational loans. On the VA product, which is the last product on our segment here, is that the VA home loan is designed to help support our veterans in homeownership. So as a zero down payment option, a little more flexibility and guidelines to encourage homeownership for our veterans. And there really is no maximum loan amount for the VA loan product. All right, I'm going to just talk a little bit about mortgage insurance, and it's kind of dovetails off of our product segment because I get a lot of questions around mortgage insurance. What is it? How does it work? What am I paying? There's two forms of mortgage insurance depending on your loan product. The first side of PMI, which is called private mortgage insurance, is attached to a conventional loan. And then an FHA loan has MIP, or mortgage insurance premium, which has two forms. So let's dive into both, and then I'll kind of give you some calculations for both scenarios. On a conventional loan, it is based upon your down payment, your credit score, and how much you finance. So the more I can put down, the higher my credit score is, the less cost I'm going to pay in PMI. And it does have a cancellation option. So once I have 2 years in my loan and 20 to 22% equity, I can apply to have the mortgage insurance canceled. FHA doesn't have that. There actually is no cancellation option with FHA. The only way I can get out of mortgage insurance is to refinance from the FHA product to the conventional loan. On a conventional loan, if I'm putting 3% down and let's say I have a 740 credit score, my PMI is probably about $154 a month. All right. So if you started some of your home search and doing some calculations on Zillow or Redfin, some of the calculators there might not be calibrated to what they actually you'll actually be paying. So they might look a little bit inflated. But we have some wonderful calculators on our website. You can see the actual PMI scenarios. Now, FHA has two forms of mortgage insurance, as I mentioned: monthly mortgage insurance at 0.55% and upfront mortgage insurance at 1.75%. So there are two forms of mortgage insurance. And the 1.75% gets baked into your total amount financed, and then the monthly you pay, of course, on a monthly basis. And we've provided the calculator below. You can see the upfront mortgage insurance as well as the monthly. Well, mortgage insurance, what does it do? What's the purpose of it? Both FHA and conventional mortgage insurance essentially insures the lender against default by the buyer. So that's the whole purpose of it, and that's where it comes into play. And especially on the conventional loan, it's different risk levels that the PMI is calculated at based upon that down payment and that credit score. All right. And as I mentioned earlier, for some of you that joined late, if you do have any questions as I go through tonight's content, just feel free to drop those questions in the chat or the Q&A. And I'm watching both windows, so we'll take on some of those as we roll through tonight's content. I'll also spend some time before we wrap up tonight, just taking any other questions. We'll kind of carve out a little bit of time as well too. All right, let's talk a little bit about income in different employment scenarios, because we get a lot of questions around that as clients are considering home ownership. And so I'll walk you through a few different scenarios that we have that come up as we kind of interact with our clients throughout the country. I did also want to pass along some of the general documentation requirements as you start considering home ownership, so you can see those on screen. So let me share back with you some different employment scenarios that I think might be helpful for you. So as you're considering home ownership, we do have to evaluate a 2-year history of work, but it also includes educational background. So if you just graduated from UCI in the fall and you started a new job January 1, we can incorporate what you've had in your time at UCI along with your new job that you just started January 1 to validate employment/work history. Here's an example of a client in Texas that I was sharing with the class last night. We have a client that just purchased their home last month, just graduated in business school in May. They hadn't started their job yet. They were going to start actually in July, but they wanted to purchase their home before they started their new job. You can do that in financing as long as we have an executed offer letter. We can obviously show your education or college transcripts. Then you can still be eligible for financing. That client was able to close last month and starts their job this month. So those are scenarios where I think people don't really know that you can actually do that. And that's completely allowed in financing. So you don't have to necessarily be on the job 2 years. We just have to build that 2-year work and or education history. Now, if you're in a position that has maybe a base salary plus some variable components, like let's say bonuses or commissions, whatever the case may be, in that case, an underwriter is going to do a historical average of those earnings. So generally, they'll average the last 2 years of those variable sources. If you have RSUs, so restricted stock that you would want to use, those can be potentially counted as income sources. Generally, we'll want to see that you've been on your job 2 to 3 years. Actually, that should be 3 years. And we can do a calculation of vested shares towards your income. If you're self-employed, we do have to show that you've been filing taxes as a self-employed individual for 2 years in order to be able to count that source of income. And some of my clients that I work with have multiple jobs, right? They're in the healthcare industry. They work for 2 different employers. We can count that income as long as they've been with both employers simultaneously for the last 2 years. And sometimes we'll also get clients that have maybe a full-time job, but they do some work on the side, whether that's, driving for Uber or Lyft, or maybe they have their own side business, whatever that case may be. If we do want to add that extra source of income, then we have to show that you've been in both positions for 2 years. All right, so that gives you just a little bit of idea of some of the scenarios we come across. The last thing I would probably share back with you is around rental income, because in some markets we get clients that are renting out rooms and they want to maybe have that roommate join them with the next purchase. Most programs are not going to allow that source of rental income into the equation unless we're going to do like a multi-unit property. Also, if you have a partner that contributes to your household income and expenses, unless that partner is going to be a part of the loan application, then we can't count that income into the qualifying. Now, I mentioned and kind of hinted at this earlier, we do evaluate expenses versus your income, and we call that debt to income ratio, taking in consideration your existing debts like credit cards, personal loans, auto payments, along with your projected house payment. And so I always like to kind of share this with our class just to give you an insight of what a lender looks at when it comes to qualifying for your home financing. So if we took into consideration those credit cards and personal loans that we have, but we also add in the expected mortgage expense, so the principal and interest of my loan, a mortgage insurance, because maybe I'm putting less than 20% down, taxes, insurance, those all get factored into the home buying budget, right? And generally, we want to make sure that those expenses do not exceed 45 to 50% of that pre-tax income. And we provided a calculation here, or an example, I should say, of someone that's has about $3,000 in expenses. They're making $8,500 a month. So their debt to income ratio is about 35.3%. So that's well within the guidelines. The question I get often is, well, Jason, what's kind of the affordability level? Where should I be, right? And I would say, most clients feel pretty comfortable if they're at 33 to 36% debt to income ratio. That seems to be kind of the comfort zone. At the end of the day, This is just a metric to help us understand more about your qualifying for your home financing. Doesn't necessarily dictate affordability. And that's one of the conversations we have as part of your consultation, is to better understand, hey, where am I at today from a rent perspective? And where do I think I can go with home ownership? And most clients, before they get to the consultation, haven't really thought about that. But I think that's an important conversation, because I may be good at $2,500 in rent now, but am I good at $3,500 or $5,000 from a mortgage perspective? Last thing I want to kind of share with you when we kind of talk about building a plan for home ownership outside of the workflow is down payment. And down payment considers, well, I should say the savings for down payment can be considered from different sources, right? And we have some of these sources on screen. That's essentially the different asset accounts that I can use to pay for my down payment and my closing costs to buy a house. So not only am I saving up for my down payment, but when I buy a home, I also have closing costs and prepaid items, which will generally be about 2 to 3% of your purchase price. Now, some of the asset accounts that you can use can include checking and savings accounts, but those assets have to be seasoned for 60 days. Cash is not acceptable. Retirement accounts can be used, 401ks, investment or brokerage accounts can be used. I always encourage our clients, talk to your tax and your financial advisor before we access those assets, because we don't want to create any type of tax liability for yourself. And gift funds can be also used in a home purchase. And that's where a family member is helping contribute to your total out of pocket. And there's kind of a documentation process for that. Well, this is probably one of the bigger challenges for most first-time buyers. You know, we might be new in our careers and the monthly payment feels good, but I'm just lacking enough resources to hit the mark from a down payment perspective. So one of the things we teach in our classes is just a savings plan. And it's very, very simple calculation, but it looks at, and we say, ultimately, I'm paying $2,000 a month in rent, right? And we figure out what your mortgage payment is, the affordable level is, right? So what we would say is, let's start saving today, like we're making that $3,500 mortgage payment. So I'm at $2,000 today in rent payment. On the first of the month, I pay my landlord his payment. And then just as part of just my process, I'm taking another $1,500, which makes up that total $3,500 mortgage payment. And I'm putting $1,500 in my savings account every month repetitiously. By the end of 6 months, I have, $9,000 saved. By the end of the year, I have $18,000. And it's just a great way to start building up your down payment reserves for your home purchase, but also creating that kind of discipline of, hey, I'm used to paying that $3,500 mortgage payment. When I eventually get the keys to my house, it's not a big deal to start making that monthly payment. So that's a great way to kind of get on that path towards homeownership, and especially from a savings perspective. Now, there's also assistance programs that can help you along the way. So we're proud to be the #1 provider of the California Housing Finance Agency assistance programs in all the markets we serve across the state. And there's various resources you can pull from, like the My Home Assistance Program, which provides up to 3% of your sales price in assistance for a conventional loan, 3.5% for an FHA loan. And it essentially is a low interest rate loan provided by CalHFA at a 1% simple interest. And it does not require repayment until you either sell the home or if you decide to refinance in the future. That helps with our minimum down payment. You can also add on resources like our My Access program, which is up to 2.5% assistance for closing costs, or the ZIP assistance program, which is anywhere between 2 to 3% of your loan amount in assistance. Those are both, well, the ZIP assistance is at 0 interest. My Access is at 1% simple interest. And you may have heard about the CalHFA Dream for All program. We currently have clients that have received vouchers and are actively shopping on that program. We'll see if that product gets more funding down the road, but it essentially provided up to 20% of the sales price in assistance, or $150,000, whichever is less, that can be used towards down payment and or closing costs. So that's a great program. We have here that the lottery program is opening early 2026. It's actually closed, so we have to make an edit here, but we may have future funding on that. We'll obviously share that back with you guys. If we do have a funding availability there. This does have some unique requirements in that one of the buyers has to at least be a first generational buyer, meaning they haven't owned a home in the last 7 years, and their parents don't currently actively own a home in the US. These other programs here are all just first-time buyers. So a first-time buyer definition means that I haven't owned a home in the last 3 years. These other programs I just want to kind of spotlight here. There's the Pathway DPA program for FHA that we have within APM. There's also the Golden State Finance Authority, but generally that's going to be a secondary option to some of the offerings we have with CalHFA because they tend to have a slightly higher interest rate offering, and then the assistance rates tend to be a little bit higher as well. And then Fannie Mae and Freddie Mac have low income housing resources available, some grants that are available if you make less than 80% of the median income. Now, I want to give you a quick scenario on CalHFA just so we can kind of give you a little more context here. So let's say I bought a $500,000 home, and we know the minimum down payment from our product segment is 3%. So that's $15,000 plus I need closing costs, which are going to be somewhere between 2 to 3%. So I probably need to buy a $500,000 house today, somewhere around $27,000 to $30,000. Well, if I plugged into some of these resources, I could maybe get my down payment covered. So maybe I'm putting 12 to 15,000 out of pocket. If I needed more resources, I can pull from the My Access program or the ZIP program, and maybe get up to $27,500 in assistance. So that's how we kind of implement and deploy funds like this to be able to help reduce down the out-of-pocket expense for our first-time buyers that do want to participate in the CalHFA assistance program. There are minimum credit score requirements. There's a 640 minimum for the FHA product, 680 for a conventional loan. If you're considered low income, it's 660 for the conventional product. There's maximum debt to income ratios. As I mentioned earlier, a first-time buyer is someone who hasn't bought a home in the last 3 years. And this is only eligible for one-unit properties, which would mean single-family homes, new construction, condos, townhouses, even manufactured homes. But it just has to be on permanent foundation. So you can't buy in a park or something like that. Now, these income limits that we have on screen, ironically, these aren't the current limits. They've actually gone up a little bit. I believe LA County, for example, I think is 216 today. We'll get you guys out the updated income limits tomorrow when we send out the slides, but they just went up this morning. So they just released those at about 9 o'clock this morning. And those income limits vary by county, and it's up to 150% of the median income is where those limits are today. All right, we're hitting the home stretch here, so I appreciate everybody kind of staying online here with us. And I want to talk probably about one of the more important parts of home ownership is just really understanding the roadmap, right? Where do I go to start the process? And when I'm ready to go, what does that all look like for me? Well, after tonight's class, I'd love to be able to get connected with you for a one-on-one consultation. It's a 30-minute session that I do for free for you. It's completely an option to just provide value to you and just kind of pour into you more information around home ownership so you can really make a great financial decision. And so we do that throughout the day with clients all across the country. We design a home buying plan. And then what comes out of that session is going to be just kind of this is the framework for you in home buying and to issue you a pre-approval. Now, you don't have to run out and buy a house right away just because you got pre-approved. At least just understands that you have a baseline for what your eligibility looks like. The pre-approval is good for 60 days, but we can always recertify that at any time. So that's kind of the starting point. And then from there, it's kind of up to you. Do you want to start looking at homes right away or just want to kind of let things sit and maybe look later this year? But the next step would be the home buying process, or house hunting, I should say. It usually starts online and then it eventually kind of transitions to going into open houses and kind of checking things out. We would always encourage you to talk with a realtor in your local market. We have a fantastic network of preferred realtors. So if you ever want us to introduce you to one of our trusted resources, we're more than happy to do that. I get asked all the time, Jason, what's the longest cycle in this process, right? And I think it's number 2, because you might want to be in a certain community. You might have a certain lifestyle that you want to have in a house. You might want a certain type of house, right? And so, that could take 2 to 3 months to find. Sometimes it takes 2 to 3 years. Now, eventually you'll find that right home. And when you're working with your realtor, you will, when you've identified the home, present an offer to a seller. And if that seller accepts the offer, then you start continue to move through this workflow, and you would now go to step 3. And step 3 means you're now entering escrow, where you have a ratified contract with a seller. And it will set some timetables on things that you need to do, like investigative work on the house, when you're going to close escrow. Usually most escrows in California close in somewhere between 21 to 30 days. We have some accelerated timelines that we can do, closing as quick as 14 days. The day you get your offer accepted, you're going to get a call from me saying, hey, congratulations, your offer's been accepted. Let's talk a little bit about the market, what's happening. Let's talk more about like your contract and your timelines, and schedule you for your follow-up consultation so we can kind of start diving into all of the elements into your home buying plan. Now, because we'll have an accepted offer, we know all the terms that you've agreed to with the seller. And so we'll do that within a couple of days of that accepted offer. We'll also be starting to get disclosures ready for you that will highlight all of the numbers for you in your home financing. And as part of that, you will start having some action items on your side. You'll have to make an earnest money deposit, which is a good faith deposit that counts towards your out-of-pocket expense. Usually a deposit is the equivalent of 1 to 2% of your purchase price. It counts towards the out-of-pocket expense, and it is protected by what we call contingencies in your contract. Those contingencies allow you to do some research on the home, like let's get the house appraised to make sure it's worth what you're buying it for. Let's get your inspections done. Let's get your loan approved. That will all happen within the first 7 to 17 days of the contract here in California. And that is a protection you have for your deposit. So if something just doesn't check out right for you, you still have those protections where you can't lose your deposit while you're doing that investigative work. So now we're kind of moving along in the process. We get to step 4. That's a lot of the administrative tasks of the loan, verifying your employment. We are going through and verifying your assets, making sure your product is set up correctly. That will be part of the steps after we do that follow-up consultation with you. Now, one thing I want to kind of touch back on is interest rates, and that's really important in today's market. We talked about kind of the general interest rate climate. It obviously remains still very volatile in the market. Now, once you're under contract at step 3 here, that's when we can start thinking about locking in your interest rate. And we're going to kind of coach you through what the market looks like. And, we'll start, giving you some data points to say, hey, this is what the market looks like. This is when we should probably think about locking in interest rate, because interest rates change by the minute during the financial trading days. So interest rates open at 6 a.m. They close at 2 p.m. Barring any holidays or whatnot. And so that's when interest rates can change. So we have to be very strategic in how we approach that. Step 5 is going to be the loan approval phase. That's where an underwriter has officially approved your loan. We've now kind of pushed our way to about 2 weeks into the process. And at that point, we're going to issue you your final disclosures. Now, you've been receiving disclosures throughout the process, but we're going to give you your final closing disclosure at step 5, which essentially gives you a 3-day cooling off period before we get to the very final milestone. And that's called closing the loan. That's the one time we do need to have you in person, aside from looking at your house and checking out the house for inspections. But the final closing is an in-person appointment with the public notary. It takes about an hour or so. You'll also deliver final funds on that day. Those monies get collected in. We also wire in your funds for your mortgage financing. And then an escrow team in California would record everything with a local county recorder's office once they have all the funds reconciled. And they'll record a grant deed to transfer ownership as well as your deed for your mortgage. And we'll generally get confirmation within 24 hours of those recorded items. And then once that happens, now you become the new homeowner, and we get a chance to celebrate with you this massive accomplishment. It's a huge deal, and we love to celebrate with you. We have wonderful housewarming gifts for you and stuff. It's a really, really cool accomplishment. Our relationship, though, doesn't stop with our clients there. I mean, this is not a transaction for us. This is a relationship that stretches several years. After the closing of your home, we have our aftercare program to stay in touch with you on what's happening with rates and notifying you when refinance opportunities present itself. Our HomeBot tracking system, so you can kind of track your home equity and work on ways to accelerate the payoff of your loan if you decide to do that. And of course, checking in with our clients on an annual basis. So that's really super important to us. I had a question that popped in really quick before I talk about technology. Question when it came in: is there any website service you would recommend for house hunting online? I have heard mixed opinions about Zillow. It really just depends. I think the value of a realtor is really important. Generally, most realtors will have some type of portal that they have that will kind of grab listings, and they'll be able to filter things a little bit better for you. So, obviously Redfin, Zillow, those are great tools, but they are, in some respects in the industry, a lead generation tool for realtors. So you may not be getting all the information that you need to make a good decision. So I think it goes back to kind of partnering with the right realtor. All right. Thank you for that question. Appreciate it. So as we think about moving forward in the process, if you want to get started and kind of going through that consultative process with us, I'd love to be able to partner with you guys on this journey. It starts with a really simple 3-step. We call it the Get Started information, an online application. As a reminder, we only do a soft credit check, so you don't have to worry about your score being impacted. You'll upload some of the required documents, and you'll just use our scheduling system to schedule a call that works on your calendar. So that's how we got to get started in building a plan for you around homeownership. Reminder, this is just a free service we provide. And if you have some questions after tonight's class that you don't want to ask in this session, you can always just schedule an introductory call. We'd love to be able to connect with you. And here's kind of what that consultation process looks like for you. It really helps you better understand budget and process, credit opportunities, product placement, all those really important things that you'll need as you kind of consider homeownership. And with technology, we can start the process via mobile. We really try to embrace technology and how we create more efficiencies in our process, whether that's using some of our AI tools, starting your process through mobile. But I always like to share with our classes, it doesn't replace the human touch and that element in really guiding you through homeownership to be a partner with you on this journey. So we want to make sure that you have us as your partner to really help guide you from classwork to attending one of our consultations to having that home buying plan in place and being able to really find the home that really works for you. So I appreciate you being a part of tonight's class. Hopefully you've enjoyed some of the information I've been able to share back with you. This is all my contact information. So if you want to get connected with after class, you can shoot me an email or reach out to me via call or text. Love to be able to provide you any information you need. And, I would say we also love what our community says about us. So feel free to check out, what, clients are sharing about us in Reddit communities or just some of our testimonials on Google. And of course, on Instagram, we're trying to put a lot of good content out there to help you better understand more about the resources available to you in homeownership. So with that said, I want to kind of just open it up for any questions that our class has and be able to stay online. I know we got one question there. I'd love to be able to answer any questions that our class has that I can help with. And I know it's a Thursday night, and I think I'm right in the middle of World Cup soccer too. So I get that too. So if you guys are multitasking, I totally understand that. All right. All right, everyone. I think we're good. All right. You're very welcome. Thank you so much. Thank you so much for being part of our class. I hope you guys have a great rest of the week. Enjoy your weekend, and I hope I get a chance to talk to you all soon. Have a wonderful night. Good night.